Sure, Mol. I'll just clarify. We don't just invest into distressed assets or across the board, and we represent various international investors into India. We do some domestic transactions as advisors as well. So, I mean, I think that you're asking me what the problem is, and then we'll come to the solution later, right? I see the problem as being kind of twofold on a practical basis because we have to do this every day for a living, right? We handle these particular types of situations. The practical situation is that very often consortium of lenders are not coordinated well, especially the PSU banks with private banks or PSU banks amongst each others, because we live in India and that's part of the way, the inefficiencies that are there in the system. I'll give you an example. We recently did a trade where where one of the PSU banks was the lead lender, and everybody else had agreed to a certain haircut. The one person was sort of holding out, and not for any good reason. So I had to personally go and meet the bank chairman and said, listen, everybody, there's price discovery, everybody's figured this out. Can you please do something? And he said, yeah, sure, that makes sense, let's do it. And it was done the next day. So it's not like, it can't be done. It can be done. It's just that this is a new paradigm for India, right? Like we are moving, and like Mr. Subramaniam said, this is a point of inflection and transition. We're going from an old-fashioned system in India and other countries of relationship lending. You're my friend, so I'm going to lend you lots of money, right? To it being based on empirical standards, right? And that cleaning house has to happen. It is going to be painful, but it needs to happen. There's no choice about that. Um, yeah, please. No, please go ahead, sir. I'll make my next point after. So, I completely buy your point, and just again to your point, I think that this is a systemic issue that we face in India, and especially since we represent a lot of international investors that are used to doing things in a straightforward manner. When somebody says a contract says ABC, that contract says ABC. It's not like after the contract is signed, you can just renege and say, you know what, I don't feel like it now. We also deal with situations, for example, where there's binding term sheets on both sides, everything is done, everybody said okay, it's done at 9,000 crores, and suddenly the promoters said, "Nahi, mujhe nahi chahiye, 9,100." So I think that moving trying to hit a moving target is very difficult in anything, and in restructuring as well. So if you're trying to hit a moving target, eventually the target has to stop moving, which it will, I think, at some point. Well, it depends on whether you would want to go bald, or whether your head is going to be cut off, right? I mean, so I think that I'd rather get a really short haircut, right? That being said, this is a one-time phenomenon. I believe that this is a time when India is going to go through its transition. It's going to go through a bit of pain, and I think that between the Yes Bank fiasco, INFS, NPA issues right now, we're kind of learning our lesson, right? The flip side to that is that I think that some of the processes are being put in place right now, and these are teething issues that in the next 2, 3, 4, 5 years will become much more easy and more aligned to how international investors think, and make the systems more transparent and efficient. And to Mr. Subramaniam's previous point, I just want to add from the borrower's perspective, to prevent this from happening in the first place, right? I think that the CFOs need to be the disciplinarians in the organization. See, entrepreneurs, I'm an entrepreneur, right? We have a bunch of businesses, investment banking is one of them, right? And entrepreneurs by their nature are very rosy thinkers, right? Otherwise they don't become entrepreneurs, and they will always think that they can service any debt they want. It's the CFO's job to say, yes, I know you're the boss, but let me tell you, you should not be borrowing this money. You should either be divesting a little bit of your equity right now, which Indian promoters hate doing because they believe it'll be worth 100 times in 10 years, right? And not borrow, or you should borrow judiciously with our current cash flows and maybe a little bit more of the projected cash flow, so that we know we can service the debt and we don't find ourselves in this situation that some of these people are, or find ourselves again in this situation post restructuring. Yeah, that, of course. I don't listen to my employees either very often, but sometimes they say, hey, maybe you shouldn't be be doing this, and it's their job to bring that up, and it's my job to decide whether to listen or not. But of course, even I think I'm going to be a billionaire in the next 12 months. But let's see. Yeah, Upma's gonna borrow. I'm gonna borrow some money from her, and then we'll take it from there. So I think that the first question that you asked was on the IBC process and whether there'll be a deluge, right? So I think that yes, first of all, there will be a deluge, and I think that it's going to happen in the following order of prioritization. The first people that will get restructured are good promoters that had bad luck, right? Bad luck can mean a COVID affected company, for example, that has severe cash flow crunch, hospitality, some hospital chains where the government forced them to have caps on the amount that they could charge customers, etc. Totally exogenous circumstances. Sometimes government inefficiencies and risk as well. We have a bunch of road developers, for example, which were supposed to get certain land and it didn't happen at the last minute. There's a port that we're doing right now, for example. Situation happened where at the last minute the government had some issues. This is the Indian regulatory risk, right, that we kind of face. So good promoters, bad luck is the first thing. The second, I think, would be good businesses but bad luck and change of promoter face, right, is going to be kind of the second stage. And I feel like the third will be bad promoter and bad project, and then you'll have someone coming on and saying that, listen, this is a bad promoter, it's a bad project, but you know what, we have high risk appetite, and we're going to buy this for 20 cents on the dollar. And the bank will say, okay, let me think about this. This is a terrible promoter, it's a terrible project, we're not executors, these guys are executors, they know how to build a building or a port or a road, let's let them get this off our hands. So I think it'll happen in that sequence, and there will be a deluge. I'd like to add to that, Mol, if you don't mind. Both Ms. Goyal's point and Mr. Subramanian's point. To Subramanian's point, I totally agree that the opportunity cost for time is high, right? And the bandwidth of anything is human beings. We're people. There's a certain amount of bandwidth, time, and not everybody is an expert in everything. So I think that it is important, while we go through this process, for either the lenders to transfer the loans to either entities that know how to handle those specific industries well and know how to take them over and run them and do their job of banking, right? Which is more important, as Mr. Subramanian very, very, very well pointed out, And, to Ms. Goyal's point about, the fact that, I think that banks, do need to help and do need to get clean and clean up their books and to make that move forward. There are international funds that are there now, right? Who, like for example, we're mandated to deploy $5 billion by one of our investors in the next 2 years into this specific thing. So Ms. Goyal, if you have anything that you need, let me know. I have a $1 billion check ready for you anytime you want. So we'll talk about that offline. I'll clean up your books for you. I think that this is something that is going to happen, and it is the smart money that comes into India along with the partners that know how to navigate the waters. That is very important. Otherwise, international partners do not know how to walk the corridors of a PSU bank, and then another PSU bank, and then another PSU bank, and get one signature, and then take that same piece of paper and get another signature, and then somebody physically has to actually do it themselves. Because if it's left to the banks, it never happens. Okay, so let me answer those separately, and if you could remind me about the points, just in case I forget, the three questions that you asked. Right. First of all, I'm going to come back about the vulture fun point at the end as well. Look, everybody likes a discount, right? If you buy a shirt 80% off, would you take it? That you like usually? Yeah, so would everybody else, Except when those guys get a discount, they make a bunch of money, personally, right? So, you have a situation where in the Western world, right, you have US endowments, charities, pension funds that have the concept of a minimum amount of return that they require, the required return. For example, let's take an example of Harvard University, right? Or I'm going to Harvard. Their endowment is $40 billion, right? 40. Columbia's university is about 20 billion, approximately, right? Now it costs a lot of money to run Harvard University, right? And all its programs all over the world. So typically, they need a 7, 2.5, let's call it 8% return, to kind of break even. 5% needs to be dispersed for expenses towards the university itself. 2 would be kind of inflation, and 1 would be the administrative cost of handling the money itself, right? So 8% is really what they need. In the US, where they're going to get that? Money's at zero. The stock market's at an all-time high. There's no guarantee of any return there, right? How are they going to get their 8%? Now, people talk about, they have to reach for yield. Where are they going to do it? India cannot be ignored, right? And therefore, they need to have high margins of safety and so high risk return in certain things to adjust so that they can get to 8%, average, right? After some treasury bonds, etc., etc., etc. If you look at, this, it used to be, stressed assets used to be an alternative investment, right? And used to be on the fringes of the investment world, right? That has completely changed since global financial crisis because of GFC, interest rates were brought down practically to zero, right? And then, all these entities needed to figure out how to make money. If you look at CPBIP, for example, everybody says, how can we compete with CPBIP? The cost of capital is so low, right? Why is it so low? Because of Indians. Let me tell you that. Canada has a GDP of 1.5 something trillion, approximately the same as the state of New York. Okay, they have high taxes and a lot of money goes towards pensions, right? So you're guaranteed money for life. You're never going to be poor if you've worked especially in the government service in Toronto. More people immigrate there, and therefore, eventually, they know that there's going to be a requirement of somebody getting $5,000 a month in 30 years or 40 years. That's going to happen, right? So if they do not reach for yield, right, they are eventually somebody's check is going to bounce when the postal worker goes to in 50 years to cash his pension check. There's not going to be any money. So there's no choice, right? They're handcuffed volunteers, as Howard Marks calls them. They have to do it because they have to have reach to yield, because they have to make sure that they don't diminish over time. Otherwise, Harvard University will disappear, and there will be no more teachers in Canada. Yeah, Amol, to Mr. Subramanian's point, I think that yes, I think that there's definitely, we know this for a fact, right? That there is extra capital available 2021, 22 that would have been deployed 2020 had pandemic not happened, and now that the pandemic has happened, there are even more great opportunities in India for international investors that are nimble, that can make their own risk decisions, right? And actually, to bring up a point that Mr. Subramanian had brought up in the prior question, also the rationality of the promoter is important, and being realistic about the present, the situation that they're in, and where they're going to go. Case in point is one transaction that we're doing. We have a term sheet in the power sector. In fact, we have perfect term sheet for the promoter. Everything is perfect. 50 basis point problem somewhere, right? And this erstwhile billionaires, right? Because they were and now they're not, but they haven't come to terms with that. Reality will set in from both sides, I think, where borrowers will realize that eventually they have to compromise, and promoters will realize that if they don't, they will eventually lose their assets completely. In terms of the regulator, we're too close to the budget for me to give any comments right now. I think that, it would be much more prudent to wait until after the budget comes out to make any comments about regulations. Really, I mean, that is one part of it. Really, it's up to people like the bankers, like Ms. Goyal and I, to figure out how to get some of these things practically done, where if we have capital and they have a problem, the problems can be solved, and nobody pays you for solving a non-problem. So you identify the problem, and then once you've identified the problem, you can then go and rectify it if there's available intelligent capital and rational parties and counterparties on each side. So I purposely did not answer your question about the regulator because I feel like it's not appropriate for me to do so right now. They should come to me. I'll figure it out. I'll tell you what, these are chicken and egg situations very often, right? And chicken and egg situations require something called priming the pump. You need to put something in to make sure that the chicken and egg situation gets resolved, right? And that requires a certain type of capital that can come in and say that, okay, this makes sense. If this guy was given 100 more, but he can't be given 100 more because of some regulatory aspect or because of considerations within the domestic industry, we can go and put in that $100 instead. We know that he'll get 1,000 out later, but he can't get his 1,000 because his 100 he can't get right now. So, that's the chicken and egg situation that we break for a living. I would say both. For me, I think that on the one hand, I think that it's personally been extremely positive. I started meditating 2 hours a day, so I wouldn't have had time to do that otherwise. Whereas Mr. Subramaniam said, we've realized that probably there's been a lot of wastage in terms of travel and time and all of that. We generated as an investment bank $3.5–4 billion worth of mandates, right, in the course of the last 12 months, and I did not leave my house because I'm diabetic, and so it did not affect my business at all. In fact, I've just cut down my travel budgets for everyone dramatically for the future as well. But yes, of course, given a choice, I would rather come and have a cup of coffee with you, Amol, which I will next week, than just only do this over Zoom. Thanks everybody. Thank you. Mr. Subramani, you and I interacted before, by the way, on one of your assets. I can't remember, Zambia, was one of them. Zambia, Georgia, something. We're partners of Cantor Fitzgerald. Sorry. Thank you. Take care. Bye. Yeah. 4. Okay, yeah, I got it. 3, 2, 1. Hi, this is Sharik Currimbhoy from Goldstein, Roth and Company. Please join me along with Amol for the ET CFO Leadership Summit, which is coming up soon. We'll see you there. Thank you. See you next week, Amol. Take care, bud. Bye, Mrs. Marian. I'll send you a message and let's chat, huh? Bye. Take care.